Welcome to our exclusive session as part of our ongoing series with Mirai Asset Mutual Funds. I'm your host, Pallavi. This is the seventh session of the Wealth Wise series. So far, we've covered different aspects of wealth creation, especially through passive investing strategies. Today's session is going to focus on the current equity market scenario, shrinking alpha in large caps, strategies for investment in benchmarks, how investors can make use of passive investing, and much more. To share their insights and initiate this discussion, we have with us Umesh Kumar Della, Head ETF Sales, Mirai Asset Investment Managers India Private Limited. Umesh is a strategic thinker and has over 15 years of extensive experience in channel management, team handling, sales and marketing in both retail and banking sales. I'm also being joined by Ram Kalyan Meduri, founder and CEO, Jama Wealth. Ram has more than 25 years of experience in financial services and financial planning field. Jama Wealth has been featured as one of the 10 best wealth management startups in India by Silicon India. I welcome both of you.
Thank you, Pallavi.
Thanks, Pallavi.
So let me start with Umesh first. We're looking at the markets. They are achieving new record highs every passing day. So let me begin by asking, can Nifty 50 be considered as a core product for equity investments? What are your views?
Yeah, thanks, Pallavi, for having me on the show. So when I talk about portfolio construction, the portfolio construction generally should imbibe policy of following core and satellite portfolio strategy or an approach, which basically investing into broad-based diversified mutual funds or ETFs, which are the excellent tools for building strategic asset allocation, which dominates your long-term wealth creation goal. So these processes should ideally be part of your core portfolio, right? An investor should continue invest into active fund, which is doing good, which is basically a good track record fund. Investors should always continue investing into it. Also, investors should take as well as the market exposure through ETFs or maybe the passive funds to reduce the active risk and also to reduce the cost of its overall portfolio. We believe well-managed large-cap funds will continue to do well, and there would be funds which would still make a good case for core portfolio per se. Notwithstanding the merits of well-managed and good track record active funds, we are witnessing across the market that is increasingly becoming difficult for large-cap funds to beat the benchmark, right? And with times when the market evolves, you will see significant alpha generation, which we have seen in a country like India, is significantly going down now. And that's not restricted to India only. That is something which is happening across the globe. If we talk about the SPIVA report, which clearly says that across the globe, there are countries where the alpha has been shrinking. So the construction of these funds should shift from a active as well as the passive. Both the products should be there in your portfolio, right. And let us leave up to the market that how the market behaves. And by choosing a passive fund, you are not missing out on the beta exposure also from the fund perspective. Now, from a broader index perspective, Nifty 50 or Sensex 30 can be used for investors for getting broad-based, exposure into sector agnostic, indices, which is the hallmark for fund forming part of your core portfolio. Therefore, an investor needs to create a blended portfolio with active funds, which they believe can beat the benchmark, along with low cost, obviously market cap ETFs. So investors don't run the risk of underperforming the benchmark significantly. So it can be a combination of both where investors should look at.
Right. And in fact, just to continue with this whole thing that we're talking about, the allocation part, I want to go to Ram now. In case of large cap categories, we're talking about the shrinking alpha. According to you, from your perspective, what should be the allocation between active fund and passive funds based on indices like Sensex or Nifty 50?
Yeah, the word allocation is extremely important when you design a portfolio that's an all-weather portfolio or it's a long-term portfolio. So the allocation of right assets between equity and debt, and within equity, how much to index funds, how much to large cap, how much to mid cap or small cap. That's a very, very important decision that the investor has to make. This varies. This depends on the age of the investor, the life cycle stage, the portfolio size also. What is typically called as the risk profile. So while there's no stock answer, I would say that for a young investor who's just starting out, majority of their investments ought to be in an index mirroring instrument, an index fund or an ETF. And as the portfolio builds up, right, continue to retain majority in the index instrument such as an ETF, but also start increasing your active component a bit. Okay. And the active component could be an active mutual fund, it could be an advised portfolio on direct equity, or it could be something that they choose to buy on their own. That gives them a feeling of how the market is moving, and gives them choice. And the choice of stocks should ideally be based on very strong fundamentals, such as companies having very low debt, companies having consistently high return on equity, etc. Coming to the active mutual fund part of it, within the active allocation strategy, then as Umesh mentioned, there's a lot of data out there which says that a fund, the fund universe, I mean, if you take the large cap universe with a 3-year track record, about 30 funds have been there, of which 97% have survived. What the investor ought to, invest over time. And very few advisors or very few distributors will even recommend an index ETF or an index fund, mainly because they don't make much of a commission on that. And that's why it's very important for the investor on the long-term wealth creation journey to have a strategy where, as you mentioned, Pallavi, within the core, it's important to have a significant component of index funds and have a smattering of active funds. And when you select those active funds, make sure that these funds are consistent performers on a rolling return basis.
Right. Sure. In fact, as you mentioned, that the allocation part would depend on the investor portfolio, the age and other factors. We'll get more on that. But just coming back to Umesh, we're looking at how there's been a shift to financial flows from active to passive when it comes to the global markets, and also this trend is now catching up in India. So in the current environment, how important is the fund cost for a portfolio of the investor? And is this the only reason to choose passive? And what are your views, Umesh?
Yeah, I think that's a fair point, because as I said, there are large cap funds, there are funds on active side which are doing pretty well. An investor should continue investing in those funds, but there are you can say number of funds which are not outperforming or not replicating the benchmark in terms of beating the benchmark. That number is huge. I'm sure when in anybody's portfolio, if the underperformance is there as compared to the index, investor has all the rights to talk about the costing part. Now, if I talk about the costing part, a general large cap fund into direct plan, the costing would be average would be around 1.15%, whereas into a regular plan of a large cap fund which is actively managed, the average should be around 2.24%. Whereas if I talk about the ETFs or the passive products, the Nifty 50 based ETF, you can get on an average of 7 basis points, as well as the Sensex 30 ETF based on Sensex 30, the ETF will be costing you somewhere around 13 basis points. So yeah, cost is an important factor. When the underperformance is there, investor has all the rights to look at that perspective also. But apart from cost, also there are a few other parameters which also evokes the investor to look at for passive perspective. Because when I talk about ETFs, there are two ways to look at from an investment perspective. One is your core portfolio, and another is your tactical portfolio. So there are investors who keep active as their core portfolio. They can keep, if they have such products available in their portfolio who are doing pretty well, and then they can take a tactical call by investing into ETFs or the passive funds, where they can take exposure into other asset class like gold, or they can take exposure into international markets also. They can take exposure into broader market also. So from a theme perspective, This is one way. The second way is vice versa, where the investor wants to keep passive funds as a core, because an investor wants to take exposure into the market from an investment perspective, and then he or she can take exposure into active funds from a tactical call perspective. Or so from that perspective, that's also works very well. So it depends upon investor to investor what sort of strategy he or she wants to play, and obviously the costing, the higher portion from into passive side will significantly reduce the overall costing of your portfolio. So that's where the overall, I think, cost as well as the underperformance and your goal of investing, how you want to play that investment call into your portfolio. This all things put together works well for an investor.
Sure. And in fact, Ram, we've already discussed various reasons why investors should look at passive, and how they need to strategize their portfolio to get better returns. Anything that you would like to add on what Umesh said?
Absolutely. I think Umesh hit the nail on its head when he said that cost is indeed an important factor. What I would like to add is that, an investor won't mind paying a little bit more in terms of expense ratio if they find the performance is really good. And while the index fund, whether it is the Nifty 50 or the Nifty Next 50 or any other index, has a very low expense ratio, basis points below teens. An active managed fund has around 2.25, as he said. Now, investor won't mind if the performance of that fund continues to be high. The challenge is, how do you pick the right fund? And that's where a trusted investment advisor comes into play here, right? So by ensuring that you pick a fund which is having consistently high track record of performance on a rolling basis, as I said. Also, often a fund which is in the top 3 of in a given year almost certainly will not be in the top 3 next year. So it's very difficult to continue to pick the top ones all the time, and nobody should try to aim for perfection there. Often that may lead to undesirable results. So you're better off picking funds which are in the top 1 or 2 quartiles consistently over a period of time, if you are trying to play the active space. Of course, if you want to do direct equity, then there are multiple options available. There you have to make sure that the advisor has that additional skill also and is able to pick the right portfolio of stocks and help execute. But typically that's for more advanced investors who have the ability to indulge in direct equity on their own. So that's broadly what I would like to say, that cost is important if performance is not distinguishable. Here, there's one more term that we often hear called closet index funds. Often many large cap funds tend to hoard funds with stocks which are pretty much on the Nifty 50, right? So they may have 70 stocks or a very large number of stocks, and whereas the large cap universe is only 100. And if you look at the large and mid cap universe, it's only 250 stocks. But you will find a lot of funds which are having 70, 80, 90 stocks. A prudent investor should understand why are they holding so many stocks, and are they holding stocks which are of dubious nature in terms of their balance sheet strength or in terms of their earnings growth, and thereby not just blindly jump in, but also take a look what's actually inside the actively managed fund. Because when a fund manager is picking a set of stocks, one assumes that the stocks that they're picking are superior to what the index has. Because index, while it's great for majority of the investors, it is also true that index is itself a momentum play. A company which is doing really well in its business enters the index only after it has covered a certain ground, right? After that, we don't know how much more it will grow. And on the other side, a company which is not doing well, I don't want to take examples. Recent banks are there, which is run out of steam, exits the index after some time. So that is one structural issue with the index. However, the fact remains that most of the actively managed funds are benchmarked against the index. I, as an advisor, my company, we always recommend that a good core portfolio should have an index reflected in it, which is then complemented by a combination of actively managed funds or an equity portfolio.
Right. In fact, Umesh, coming back to you, in this series, we've covered different aspects of ETFs, the kind of benefits they come with, be it cost efficiency and diversification. But one important question that comes up is how should investors actually buy or sell ETFs? Like what could be the basic hygiene checks? If you could help us understand that.
Yeah, I think that's a good question, and I think that's a basic thing for every investor to understand. So when we talk about buying ETFs, there are two ways to buy ETFs. One is investor can go to the exchange and buy and sell ETFs the way they do for stocks. And the second option is they can come to the AMC and there also an investor can buy. But when investor comes to the AMC, investor has to buy into a lot size, which is basically minimum number of units which investor has to place an order with the AMC, and on basis of that order, AMC will create the basket, fresh basket for the investor. So that's a minimum basket size which investor need to ask for. But in case of exchange, because most of the retail investors, they would like to go on exchange, and they're only, I think, from a retail perspective, that's the place to go. So while buying and selling on exchange, investor has to, while buying, investor has to always look at the depth in the market. He should always look at the order book also. Whenever he or she places an order to buy, always the order should be a limit order rather than having a market order. It should be limit order so that in specific range, the investor can buy the units of that particular ETF. Also, investors should look at the INAV of the ETF, which are generally published on AMC's websites. INAV is basically the real-time price of the portfolio, excluding the transaction charges. So that INAV investor, while checking the INAV, investor can come to know very easily that what is the price he is going to pay on the exchange and what sort of other charges are being charged to him. These are the two important things which investors should look at. Another important thing is the liquidity part, because when we talk about liquidity into exchange or any ETF, the liquidity is nothing but the liquidity of the underlying securities on which the ETF has been created. So historically, it has been seen that the Nifty 50 or Sensex 30 are the two indices where the liquidity is not an issue. So for a first-time investor, I would recommend them to go for these highly liquid indices where based on these indices, the ETFs are there. Investor can buy and sell. Similarly, and then going ahead, they can explore other options also like your smart beta or maybe mid cap or some international ETFs and all that. So these 3-4 things investors should always keep in mind while buying on the exchange.
Sure. So some important notes from Umesh. Before we let you go, Ram, just one last question from to you. In the current market conditions, for which type of investors, passive investing will be more appealing, or it will make more sense? Your views.
See, passive investing would apply for almost all the investors. For some investors, like I mentioned earlier, who are starting early, it makes sense to go passive. Combination of Nifty 50, Nifty Next 50 will give them anyway the entire large cap universe, right? And they could even take a mid cap index post that. Starting investors should definitely do through SIP route because that averages their risk over time. Those over time, those who have access to a good SEBI registered investment advisor can consider other alternatives, such as active equity portfolios or active funds. And the other set of people who might consider passive attractive is those with very less, risk appetite. So, so basically the passive appealing would be to people with low risk profile, with smaller portfolios. But as the portfolio starts getting interesting, they could, have a combination of plays. And there are indices not just and ETFs, which are not just mirroring equity, but the bonds also, gold also. So the ETF space is very interesting, and it's getting more and more interesting as we move along with more variety of instruments being mimicked. And as Umesh said, it's very important for the investor to pick a ETF which has enough liquidity. Otherwise, the impact cost, could actually be significant, which would definitely eat into their returns. You got to pick, you got to buy something where there's liquidity. Otherwise, you're exposed and vulnerable to the wild swings of the market. So prudent investor will do this analysis and arrive at a well balanced set of instruments mirroring their asset allocation, which goes to building long term wealth.
So some insights coming in from both sides. Umesh, any closing comments from your end?
Yeah, I think I would close this discussion with the remarks which I started with. There are funds which can still give you alpha, but the investor has to very clear and selective in terms of what sort of products he is already investing into. Are these products are in line with the goal which he or she has started investing with? If the goals are meeting, if the funds are outperforming the benchmark, which is good. If not, then investor can slowly and steadily can look at these options which are already available in the market on a passive platforms where the costing is also very less. And if you can't beat the market, then it's at least meet the market. So that's how the strategy should be from an investor point of view. Also, there is a lot of innovation which Ram very rightly said, that there is a lot of innovation which is happening on the ETF side or passive side. You will see more and more innovation coming in. So from that perspective also, investors should be very clear what allocation or what sector or what sort of a theme he or she wants to invest into. Once he or she is clear, he or she should absolutely should go and look for these options available in the market. So yeah, that's it from my side.
Sure. So that brings us to the end of today's session on shrinking alpha in large caps. Thank you both of you for taking time out for this session. Thanks a lot.
Thank you.
Thanks for being part of this session. We'll come back with some more sessions. Stay tuned to economictimes.com. Thank you for watching.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.